Welcome to the channel Get Rich. So today in this video we are going to look into 5 important financial ratios which are very important to do stock analysis. So if you are doing stock analysis, there are few key metrics or financial ratios which we have to look at in order to analyze the stock. So the most important financial ratios are: number 1, price to earnings ratio; number 2, debt to equity ratio; number 3, price to book value; number 4, current ratio; number 5, PEG ratio. Let's have a look at each one of these ratio. What does that mean? So let's get started. So the first one is price to earnings ratio. What is price to earnings ratio? Price to earnings ratio is a single most important ratio lot of analysts or lot of stock market people will have a look at. If you have to look at a quick scan through a stock and to see whether it's overvalued, undervalued, or what is the current status, you just have a look at P ratio, compare that with growth. Usually the P ratios anywhere at between 20 to 30 or less than 20 is very good, but that completely depends on the growth rate of a company, because we cannot have a same P ratio for a company which is growing at 10% and also a company which is growing at 30%, because 30% growth company will go at a much faster rate, will generate profits at a much faster rate than a 10% growth company. So depends on the growth. For example, 10% growth company 20 to 30 or 15 to 20 very reasonable. 30% growth company, it's even 30 to 40 P seems undervalued because they are growing at 30-40%. So that kind of valuation is still okay. So let's have a look at how we can come up with PE ratio. So P stands for price. So price, how do we reduce price? So we have a total market capitalization. Total market capitalization is the total business value of that particular company. So if you look at the total market capitalization, for example, in this case I took Polycab India. So in this case the total market capitalization is around 36,995 crore, which is total market capitalization. And then we have a number of equity shares, total number of equity shares in that particular company. The total number of shares for Polycab India, it's about 14.9 crore shares. So if we divide the market capitalization by the number of equity shares, then you come up with the current price, which is 2476. So the calculation might be a little bit different because I used different values, or I used for previous quarter or something, but then this is how we calculate. Don't check the exact numbers, but look at the calculations. So if you divide by market capitalization with the number of equity shares, then we get the current price, which is 2476, and then which is the price, but which is the top one, we got the price. And now we have to look into earnings. How can we calculate earnings? So every company will post a net profit each quarter every year. So if we took a yearly net profit, which in this case is 816 crores, and then divide that by the number of equity shares, which is 14.9 crores. If you divide the net profit with the number of equity shares, then you arrive at earnings per share, or EPS. So now you got the earnings, which is per share, earnings per share, which is 54.7 rupees, and price per share, which is 2476 rupees. If you divide the price by earnings, then you arrive at the PE. So in this case, we arrived at 45.3. It is important that which price or which earnings you are using. You usually always use the latest current price. That's clear. But then for the earnings, you can use the earnings for current year, which is financial year 22 and 22, or you can also use the future financial year 2023 projections. So if you use the current year EPS, then it is called trailing PE. If you use the earnings for the next year, or the projected earnings for the next year, then it is forward PE. So it is important whether you are look at trailing PE or forward PE. So in this case, Polycab India, so trailing PE is 45.3. But then if you look at the potential of this particular company, if you calculate the forward earnings, it can be very less, because looking at the 45 PE, it's still fairly valued for this company, for this growth of Polycab was growing at I think more than 20%, if correct me if I am wrong. So it's growing at 20 to 30%. So 45 seems very reasonable because it's also working in the consumer business, so that's very good. So 45 PE is reasonable. But then if you look at the forward earnings, so it has a potential to increase the forward earnings to 50% for next year. So in that case, the forward PE can be, for example, at 30. So it's undervalued if you look at the forward PE. So Polycab, for example, personally I hold Polycab, I just took it for example, but Polycab is a very nice undervalued company. Currently you can buy the share for. So that's the price to earnings ratio. So price to earnings ratio is most important. So have a proper understanding of this ratio is really important. So let's go to the second ratio, which is debt to equity ratio. So the first one, we looked into the income statement. So in the income statement you will have a net profit and everything, then based on that you calculate price to earnings ratio. And the second one, this you have to look into the balance sheet. So in the balance sheet you can look into the debt, how much debt they have on their balance sheet. So in this case Polycab has a debt of about 247 crore. So that's the debt, the top part. And in the equity, what is equity? Equity is the total shareholders equity, which is asset minus liability. So if you reduce the asset minus liability, then you get the total shareholders equity. So in this case, if you just add the share capital of the particular company and then the reserves they have, so usually if you just add the share capital plus reserves, that's the shareholders equity. So if you divide the debt by equity, then you arrive at a ratio of debt to equity ratio, which is important. So typical debt to equity ratio I like. So anything less than 0.5 is very good, because if you go more than 0.5 you are over leveraging your balance sheet, or yeah, some people will say until 1 is good, but personally I look at companies which have less than 0.5, I am really comfortable with. So if they are very less, like less than 0.2, 0.1, in this case Polycab has a debt to equity ratio of 0.05, which is very less, and that's very good. But you have to make sure which business the companies are, because debt to equity ratio can be, for example, if you look at the banks or if you look at the typical lenders, so their business is lending, so they have more liabilities, so they have to over leverage their balance sheet because their business is lending. So if you look at the banks or any other lending business, their debt to equity usually 4, 5, 7, 8 or even 10. So in that case that's okay if the debt to equity ratio if for that particular business is okay. So you have to compare which business the company is operating in, and then you have to look at the debt to equity ratio. Mostly non-lending businesses, debt to equity ratio less than 0.5, it's a very good one. So that's the second important ratio. Then let's have a look at the third one, which is price to book value. So price we know how to calculate, so we just have a look. So we can arrive at a price which is current price, which is 2476 rupees. And then if you look at the book value is nothing but, so we just looked into the shareholders equity, which is share capital plus reserves. So that's a shareholder equity. If you divide the stockholders equity by the total number of shares, which is the book value is nothing but shareholders equity per share, which is book value. So book value is 327 rupees. So if you divide the price with book value, then you come at the price to book value, which is 7.58 for this case. Price to book value is it varies between company to company. So some people will hold a lot of their assets or reserves. Some people will pay out dividends, and then that will reduce their asset price to, that will increase their price to book value or reduce their stockholders equity. So it really depends. Price to book value, yeah, if it is less it's good, if it's 1, 2, 3 it's good, but most of the growth companies it will stand anywhere between 2 to 4. So here in this case we have 7.58. That's okay, that's not a big deal. So then the fourth ratio, which is current ratio. So what is current ratio? So current ratio is if you divide the current asset divided by current liabilities, which is the current ratio. So what is a current asset? So assets that can be liquid in 1 year. So if you see an asset which you can get back in 1 year, that's current asset. Also the liability, if you have to pay something for somebody within 1 year framework, that's current liability. So if you divide current assets by current liability, then you get current ratio. So this ratio will give you an overview of whether the business met the recent, for example 1 year liability, whether they can able to pay back their most recent liability or their coming liability for the coming year, for next 1 year. Are they able to capable of giving the money back to those particular people, whether they have to pay for 1 year? It can be vendors or it can be any people, it can be anyone. So that's their ability to repay the money within the 1 year. So current ratio, if it is more than 1, it's really good, because if it's less than 1, that's a problem. So current ratio, if it's more than 1, it's really good. And then if you look at the last one, which is PEG ratio. What is PEG ratio? PEG ratio is, it's the price to earning compared with the growth rate. Because when we have a look at the PE ratio, I told that, so lesser growing company has lesser PE and higher growth companies will have higher PVs. You can just tell that, okay, any company with less than 20, it's undervalued. Or you cannot say any company more than 40 is overvalued, because it really depends on the growth rate. That is where PEG ratio comes to help you. So PEG ratio is just a comparison of the PE with the annual EPS growth. For example, if you have a PE of 20 and if the company growing their earnings at 20% CAGR, then the PEG ratio will be 1. And if the company is having PE ratio of 50 and they are growing their annual EPS growth of 50%, that's PE ratio is also 1. So both can be viewed at a same particular point. So it gives a basis to compare different companies. So if the PEG ratio is less than 1, it's really a very good company. So usually if PEG ratio is less than 1, that's attractive to buy. So it gives to compare different companies with different growth rates. So PEG ratio is also an important metric to have a look at. So if it is less than 1, it's very good. So these are the 5 most important ratios you have to look at for the stock analysis. Of course, there are many more ratios which are available, but in this video I am focusing on the most important 5 ratios for stock analysis. So that's all for today, and thank you for watching. If you like this video, like, share and comment, and have a nice day. Bye.